Singaporean investors thinking about ESR RE and trying to figure out if it's time to buy, sell, or just hold? You're in the right place. I'm Iggy from the Investing Iguana, and today you're getting my honest, no-nonsense deep dive. 3 good points, 3 red flags, and my own verdict at the end. Stick around because you'll want every detail. Before we begin, a quick intro for those of you joining for the first time. The Investing Iguana is ranked 8th on the Influential Tigers list by Tiger Brokers for 2024, with our videos crossing the 1 million reads milestone and 500,000 watch hours. Whether you're new to the Singapore market or a seasoned pro, my job is to make complex stuff simple and useful. Always putting context first. Let's jump right into it. Let's start with what ESR REIT is finally getting right. First, their portfolio quality has made a huge leap. Today, more than 70% of ESR REIT's assets are what analysts call new economy. These are properties like logistics warehouses, premium industrial buildings, and data centers. These assets are in demand as Singapore's economy speeds towards tech and e-commerce. Their latest acquisitions, a major distribution center in Japan and a new facility in Tuas, were both bought below market value, and together they've stretched the average land lease on the whole portfolio to nearly 44 years. More than 70% of these assets are now freehold or have super long leases. That means this REIT's foundation is way more secure for the long run. Next, let's talk financials. ESR REIT's performance has really improved compared to previous years. Just in the last quarter, gross revenue shot up more than 5%, hitting just under 187 million Singapore dollars. Their net property income climbed as well. What's really grabbing investors' attention, though, is the dividend. Right now, the yield is around 8.5%, sometimes going up close to 9% depending on market swings. That puts them among the highest yielding industrial REITs in Singapore. The share price has also recovered about 25% since earlier this year, showing that the market is regaining some confidence. And thanks to lower borrowing costs and disciplined debt management, their leverage is in check and interest expenses have started trending down. Third, ESR REIT stands out for its sponsor support. The group behind this REIT is ESR Group, one of Asia's largest real asset managers. That means ESR REIT gets first dibs on new high-quality assets in Singapore, Australia, and Japan. Just this year, ESR Group invested over $100 million into the REIT's equity, backing its transformation and putting real money where its mouth is. For unit holders, that's a powerful safety net, especially in choppier markets. Now let's look at the critical risks. Every REIT has them, and ESR is no exception. The first thing you need to know is that land lease decay remains a big structural challenge. Even with all the recent improvements, about 28% of ESR REIT's portfolio sits on leases that will expire within the next 15 years. In Singapore, when leases get shorter, property values drop. That's why net asset value per unit has fallen 25% since 2022. Some progress has been made, but this drag on asset value will not disappear overnight. Second comes the volatility around distributions. A couple of years ago, ESR REIT paid out higher distributions per unit. But since then, those payouts have dropped by about 30%. Management is optimistic about getting back to stable growth, but it depends on a lot of moving parts, including successfully wrapping up ongoing redevelopment projects and driving higher rents from upgraded buildings. If there are any hiccups, delays in asset enhancements, or lower than expected occupancy, future payouts could still be shaky. The next big thing is the fierce competition. ESR REIT is no small player, but in Singapore, they're up against significantly bigger rivals like CapitaLand Ascendas and the 2 Mapletree REITs. These giants have more cash, can buy better properties, and get cheaper funding. ESR's lower price-to-book ratio signals that the market is still cautious. It might limit how much the REIT can grow unless it can consistently prove itself over multiple quarters. So let's wrap it all up. ESR REIT has made a remarkable turnaround. Smarter asset choices, better financial discipline, stronger backing from its sponsor. Revenue and earnings are growing and the high dividend yield is a major draw. But there are warning signs you can't ignore. Land lease decay is still gnawing away at asset value. Dividend payouts have been unpredictable, and that erodes investor trust. Plus, in a field of bigger, faster competitors, it's tough to win every time. Here's my honest view, and I want to be clear. For most investors, ESR REIT today comes down to this. There is real upside if you're willing to ride out the volatility and trust in their multi-year transformation. The current income is attractive, especially if your focus is on yield. But if you need stability from your REITs, or if you want strong, steady growth, you might find the uncertainty too much. I'm giving ESR REIT a hold rating. If you already own the units, it's worth sticking around to see if management keeps delivering results, especially if you value the high dividend. But for new investors, I think it's wise to wait. Look out for two things. Can the REIT show a full year of steady distributions? And does it keep successfully redeploying capital into new economy assets? Those are the signals for long-term sustainable growth. For everyone who wants to go deep on the data, check out the description for my research breakdown on Substack. There, you'll get the charts, extra details, and supporting documents. If you learned something valuable today, do me a favor. Hit that like button, share this video with someone who's also hunting for stable income, and subscribe for clear, practical analysis every single week. And don't forget, premium members get all my videos a week early, plus detailed alerts sent right to your inbox. It costs less than a cup of coffee a month and keeps you in the loop ahead of the crowd. Thanks for tuning in. I'm Iggy, and I'll see you in the next deep dive. All data in this video is up to date as of July 27th, 2025. Earnings, asset mix, and yield figures have been checked against public sources and analyst reports accurate to this date. As always, nothing here is personal investment advice. Do your own research and speak with a licensed advisor before making any investment decisions.